In this video we will analyze Acrysil Limited. Start with the business of Acrysil. Our primary goal is to encourage individual investors to make informed decisions and pay reasonable prices so that we can minimize the risk of losses and maximize potential gains. Acrysil is a designer brand that specializes in kitchen products. Its flagship product is the Acrysil quartz sink, which is known for its innovative design and striking looks. The brand has a strong focus on originality and the ability to delight its customers. The aim of the brand is to be the topmost one-stop brand for all kitchen product requirements. Acrysil quartz sinks are sold in over 30 countries worldwide, including the USA, UK, Germany, France, Canada, China, Far East, and Gulf countries. Acrysil has established a wholly owned subsidiary, Acrysil GmbH in Germany, to further expand its presence in the European markets. With the success of the Acrysil quartz sink, Acrysil has diversified into other kitchen products such as stainless steel sinks, faucets, food waste disposer, and kitchen appliances like hobs and cooktops, oven, wine chillers, and dishwashers. This diversification has allowed Acrysil to cater to a wider range of customer needs and establish itself as a leading brand in the kitchen products industry. Now understand the competitive advantages that help it maintain its market position and generate sustainable profits over the years are as follows. Acrysil's products are known for their striking and innovative design, which sets them apart from competitors in the market. This design philosophy has helped the brand create a unique identity and a strong brand image in the kitchen products industry. Acrysil offers a wide range of products, including sinks, faucets, food waste disposers, and kitchen appliances like hobs, cooktops, ovens, wine chillers, and dishwashers. This allows the brand to cater to a broad range of customer needs and establish itself as a one-stop shop for kitchen products. Acrysil's products are known for their high quality and durability. The brand uses premium materials and advanced manufacturing techniques to ensure that its products are built to last. Acrysil has a global presence, with its products being sold in over 30 countries worldwide. This has helped the brand establish a strong reputation in the international market and expand its customer base. Acrysil places a strong emphasis on customer service, offering excellent after-sales support to its customers. This has helped the brand build a loyal customer base and establish long-term relationships with its customers. Now let's look at the management, the key people who are vital for business success. It sets goals, plans resources, motivates employees, and makes strategic decisions for growth and profitability. Chirag Ashwin Parekh is the chairman and managing director of Acrysil. Parekh holds BBA from European University at Switzerland. He joined his family business in 1993 and since then led the company to new heights. He has experience of more than 2 decades in administration and finance along with experience of 18 years in marketing and personnel. He has received recognition for his contribution to manufacturing innovation and design at the Industry 2.0 Manufacturing Innovation Conclave. Now we will analyze the company on the basis of 6 key financial data so that we pay the bargain price to achieve without any emotional bias. The 6 key numbers are debt-to-equity ratio, return on equity, sales growth, profit growth, equity growth, cash growth, operating cash and free cash. Debt-to-equity ratio as it measures the company's level of leverage and risk associated with its financing structure. Lower debt-to-equity ratio is considered better as it indicates lower financial risk and greater solvency. Return on equity is important as it measures the profitability of a company's shareholder investments. Sales growth and profit growth are crucial for business expansion and sustainability. Equity growth reflects a company's ability to generate profits for reinvestment, while cash growth, operating and free, indicates its ability to fund operations and invest in growth. Operating cash flow is the cash generated from a company's normal business activities. Free cash flow is the cash remaining after a company has paid its expenses and investments. In this spreadsheet, we can see the year-on-year growth for the last 10 years and consider the median return and growth rate to calculate the future growth. Using the median value of 10 years of year-on-year growth provides a more reliable measure of long-term performance. For Acrysil Limited, the median values are as follows. Debt-to-equity ratio is 0.8. Return on equity 16.9%, which is acceptable. Now year-on-year growth. Sales growth 21.3%. Equity growth 21.7%. Profit growth 41.7%. Operating cash growth 35.2%. Free cash growth is minus 10.4%. A total debt-to-equity ratio of 0.8 for a kitchen equipment company may not necessarily indicate high financial risk, but indicate the company needs investment for its growth and expansion. On the other hand, operating cash flow growth is higher than its sales, and profit growth indicate that the company is generating more cash from its operations. This means that the company is managing its working capital more effectively, collecting payments from customers more quickly, and managing its expenses more efficiently. Now we will calculate the future price on the basis of three parameters: sales growth, equity growth, and profit growth. Our goal is to buy a good business at a reasonable price so that we can generate minimum return on investment 15% per year, which makes our money double approximately after 5 years. First, we calculate market capitalization to sales ratio to measure a company's market value in relation to its annual sales. Trailing 12 months sales is 587 crore. Historical sales growth is the median of 10 year-on-year growth 21.3%. Historical 10 years median market cap to sales ratio is 1.5. Face value per share is rupees 2. We get the number of outstanding shares. Now our forecasted sales after 5 years is 1540 crore. Our default market cap to sales ratio is 2, that means we are ready to pay double the sales number. Now we take the minimum of historical and default market cap to sales ratio to forecast the market cap to sales ratio after 5 years. Now the forecasted market cap after 5 years is equal to market cap to sales ratio after 5 years times forecasted sales after 5 years. Now the forecasted price per share after 5 years is the forecasted market cap after 5 years divided by numbers of outstanding shares. So the present fair price per share is the forecasted price per share after 5 years divided by 2. As per our minimum expected return on investment 15% per year and makes our money double after 5 years. So according to the capitalization to sales ratio of Acrysil, the present fair price for us is 462. Now we calculate the fair price for us on the basis of price to book value ratio to measure company's market value in relation to its book value or shareholders' equity. Trailing 12 months book value per share is 107. Historical book value growth is the median of 10 year-on-year equity growth 21.7%. Historical 10 years median price to book value ratio 3.3. Now our forecasted book value per share after 5 years is 570.3. Our default price to book value ratio is 2. That means we are ready to pay double the price of book value per share. Now we take the minimum of historical and default price to book value ratio to forecast price to book value ratio after 5 years. Forecasted price after 5 years is the forecasted book value per share after 5 years multiplied by forecast price to book value ratio after 5 years. So the present fair price per share is the forecasted price per share after 5 years divided by 2. So according to the price to book value ratio of Acrysil, the present fair price for us is 285.1. Now we calculate the fair price for us on the basis of price to earning ratio. The price to earning ratio is another important tool to measure a company's market value in relation to its earning per share and its growth. Trailing 12 months earning per share is 21.1. Historical earning per share growth is the median of 10 year-on-year profit growth 41.7%. Historical 10 years median price to earning ratio is 27.4. Now our forecasted earning per share after 5 years is 120.4. Our default price to earning ratio is double the profit growth, median profit growth for last 10 years multiplied by 2, that means we are ready to pay double the price of profit growth. Now we take the minimum of historical and default price to earning ratio to forecasted price to earning ratio after 5 years. Forecasted price after 5 years is the forecasted earning per share after 5 years multiplied by forecast price to earning ratio after 5 years. And again the present fair price per share is the forecasted price per share after 5 years divided by 2. So according to the price to earning ratio of the Acrysil, the present fair price for us is 1649.5. Now we get 3 different price according to 3 different parameters. Average the 3 prices gives us a conservative fair price of 799. Now most importantly we need margin of safety. The margin of safety minimize losses in case of mistake. So the buy price would be below 799. If we want to buy with 50% margin of safety, the bargain price is 399. If you find the video is useful, please subscribe to our channel.